Thea, I'm looking for help to review our super performance. Sounds sexy. My husband and I have an individual wrap super fund through our financial advisor. Where/how do I find other fund benchmarks to compare it to? I suspect we're paying more in fees than industry funds, so I want reassurance that this is being compensated by additional performance. I want to do my own independent comparison and not just rely on the FA. I actually made some comments on this, but what are you saying to Thea? Like if Thea was your client?
Yeah, I welcome it. I think in two parts of, there are public websites where you can go and see what all the industry funds or all the My Super funds have returned. So they're there. So the numbers can be compared. I think a few parts is one, making sure we're comparing apples with apples. Yeah. As we know, we've done deep dives around that, asset allocation. So industry super fund X might say they're balanced, but what does exactly balance mean? How much is in growth and how much is in defensive? Because they're not consistent. The label doesn't always describe what's underneath the bonnet. And so therefore your fund might be 50% growth and 50% defensive. If you're comparing that with something else that says balance that's 80% growth and 20% defensive, then yours might look like it's worse, but that's because they're taking 30% more risk than you are. Yeah, two, for us, one of the things that we talk to clients about is, well, what do you want your super fund to do? Do you want just the lowest cost, simplest option and then let's go with the low cost? Or do you want to have some more bells and whistles and you'll pay for it? Do you want to have direct shares? Do you want to be able to do term deposits? Do you want to have overseas investments? They may or may not perform, which is its own discussion, but there's a price to pay for that control and transparency. And therefore, if fees are the only thing, well then maybe we don't need to have some of those items. The other part that I'll throw to you is, again, depends if we're referring to fees just from the super fund. I think they mentioned what wrap they're on, but the wrap might have their own fund and or the advisor might have fees.
Yeah.
Advisors charge fees. That's how they run a business. Sometimes those fees are, yes, about managing your super, but often a large part of a great advisor is helping you manage your overall world and contribution planning, tax planning, doing projections for you, preparing different scenarios to map that through. They may charge that to you through your super fund, but I would then often suggest let's separate those fees or isolate those fees because you're comparing, okay, well, I'm paying my wrap account and that includes these fees to my advisor, but the advisor's fees aren't to get you an extra 1% most of the time. They're to hold your hand through all these strategy items and planning. So if you're comparing that versus something off the shelf, yes, that may look cheaper because they're not giving you any help or support or anything like that as well. To make sure that, again, are we comparing the super fund fees with the super fund fees, or we're comparing my super fund, which has my advisor fees in there as well, versus not?
So my own doodling comments, and I won't repeat what you said, you talked about the asset allocation. So we want to make sure whatever, and I've just drawn a wrap platform. Mm-hmm. So that bottom bench is we'll call it the platform, where the investments stick on and or sit on. And those investments, Australian shares, international shares, might be some property and cash, could be very different investment options. There could be just the one option, whatever. Within the investment option, you talked about asset allocation, that we have to make sure its growth versus defensive is the same. Yeah. But if you want to go further, you need to make sure with the industry fund that you're comparing to that their asset allocation to growth, sure, it's 70 and yours is 70, but within that allocation that you've got 30% Australian shares, you need to make sure that within that super fund that the asset allocation within that growth matches.
Yeah, true. Yep.
So it's very, very hard to compare superannuation funds and investments without understanding the broader asset allocation, but within the growth and defensive.
Right. Yeah.
So that's number one. You're right with the fees. There will be a fee that the platform charges, which doesn't go to the financial advisor because that's illegal and has not happened for over probably 20 years now. So I want to dispel that myth. And then if, for example, the Australian share portion was an index fund managed by Vanguard, there's a fee for that option that goes to Vanguard. If the international thing is managed by Perpetual, there's a fee that goes to Perpetual. So then the fees for the investments work out to be a fee. None of it goes to the advisor. It literally goes to the fund manager. Within that, and this kind of speaks to the asset allocation, you want to make sure that the investment style is the same as well. If you have a wrap account and your financial advisor has a model portfolio in there, and I'll give you an example, there could be a portion of Australian shares, micro or small cap, that's actively managed. There will be a higher fee for that actively managed portion, where you might look at an industry fund or a pre-mixed portfolio where the whole portfolio is indexed. So again, another layer of comparing apples with apples. Then you'd pay. Now, you could set up a wrap account and have the investments on there. Some of them are direct to consumer. You can do that yourself. Then if you choose to pay an advisor or a portfolio manager to work out what goes where and what not, that's an extra fee that goes to the advisor. But as you touched on, it's not just investing. And you can research, everyone, just Google Vanguard Advisor Alpha. There is data that is, and Russell did it as well. There's actually data that says, and this is where people just light their hair on fire and can't get their head around it, by paying advisor, having someone in your corner, you will get probably a 2 to 3% better outcome, because they'll help with the behavioural things and won't be like our first questioner, Lynn, who said, should I move my investments to low? Well, if you're paying an advisor, they'll say, no, Lynn, this is why, and you wouldn't do it, and you wouldn't try and time the market and lose.
And I think just jumping on that Vanguard report, and just you worded it correctly there, but it's the Vanguard's not saying an advisor is going to get you an extra 3% return every year. They're saying they're going to get overall result, because they can optimise your tax, they can ensure that you're invested appropriately. That investor behaviour is ensuring that you are investing regularly and not making short-term decisions. Because there was a whole bunch of studies and reports that came out during the COVID period around how many non-advised clients actually made changes to their super funds and at the wrong time in the cycle moved to the defensive option. Whereas perhaps if they had an advisor who could pick up the phone and have a talk to, oh, okay, no, yeah, you're right. No, thanks for reminding me of that. No, it's fine. I won't make a change now. And all of a sudden, when the market recovered within 4 months, they're back to where they were, versus if they were at home by themselves in front of their laptop, they might have made a silly decision.
The other thing, and you did touch on it, but we'll just bring it home. Sometimes I pay a higher fee because I need something and I can't get that something from a lower fee. One of the things that comes to mind could be around estate planning. I want some more transparency of my investment portfolio. It might be that, and you'd probably see this more than the average bear with your clients, in terms of, like, we don't run everything in our life like what's the cheapest, but there could be, like, if Thea had a portfolio that's in super on a wrap and they had some investments outside of super on wrap, there'll be internal packaging discounts. So you really can't
compare.
So anyway, what I would say to Thea, if we cut to the chase now, you want to do your own independent comparison. Look at the investment report from your advisor. Just start with overall asset allocation. Number 2, you could ask them, hey, could you run a benchmark report to the most equivalent matched benchmark that you can find for the portfolio that we're invested in? And even, I'll just have a look. I got an email the other day. So in my self-managed super fund, maybe I deleted it. I just use Vince's Life Sherpa in my own self-managed super fund. He sent a performance update.
And what Glen's pointing out, what he means by benchmark is...
Yes, explain that.
If we're comparing a balance versus a balance, making sure that there's a benchmark that averages all of the true balances. So if you're comparing how my Aussie shares did versus my international shares, the Aussie share has its own index, the international has its own index, the international emerging markets has its own index. So you're comparing like with like. And so there are probably 50 different benchmarks in Australia measuring all different things. So how well do I do? Well, compared to what? If it's against a term deposit benchmark, that's going to look very different to a conservative benchmark or a high growth or an international share benchmark.
So, for example, a real example is the cash rate at your bank. We'll do mortgage.
Yeah.
If you've got a mortgage and you're paying 5.8%, the benchmark is the RBA cash rate. Yeah. To be fair, what is it, 4.1 or something? What is it at the moment? You should know.
4.1. That sounds good to me.
I'm just going to fact check myself live. Reserve Bank of Australia. No, it's 3.6. I don't know where I got.
Okay. Well, maybe we're paying too much.
Mate, no, I was actually thinking term deposits, maybe.
Yeah.
I don't know, whatever. So the actual cash rate that the RBA charging.
Yeah, that's the benchmark.
That's the benchmark. Your home but we know that the bank are making a profit between the cash rate and what you're paying.
Yeah.
You could do it the other way. The benchmark for the
rates,
term deposit or the savings rate will be less than that benchmark because they need to make the spread.
Yeah.
And just while I was doing that, as an FYI, everyone, if you do listen, my phone was buzzing, that's why I got it out of my pocket. It was a New Zealand number. We're doing a live show in New Zealand on the Wednesday night, 18th of Feb in Auckland. I'm doing a money live show. So if you want to come along, I'll put tickets in the bio on that. So I'm just looking at this investment report that Vince has set through for my investment. Okay, so for example, in one of these reports, I don't want to dig too deep. The portfolio that I'm in, they've got a 3-month, 1 year, annualized, 3-year, annualized, 5-year, and a 10-year. Tells you the return for the portfolio. It tells you the components of the portfolio, but also at the top of his newsletter, it also has a heap of the indexes. Yeah. Now, I don't have time to find benchmark because he does have stuff where he's benchmarked his portfolios to VDHG, but it's just got here, the S&P 500 for that same date range, it was 15.28%. The Australian ASX 200 over 10 years was 9.31, where the portfolio that I'm in, if I just invested in the ASX over the last 10 years, 9.31. The portfolio that I'm in, 11.04. Yeah. That's more of a diversification play.
Yeah.
So benchmarking, it is good to know.
Yeah.
There's a funny thing I used to say, and it annoyed people online, and I would say, after fees, an index fund will always underperform the index.
That is correct. Yeah. Because if they're getting the index, it's always going to,
you'll get the index, but you've got to pay the fund manager. So you use index investing and it doesn't outperform the index. Yeah. But it's a bit tongue-in-cheek.
No, again, we'll move, other than I'll add it as well, is we have some portfolios we run for clients and we don't run them in-house. We use external experts as well. But one of them in particular, over the last 5 years, it's returned about the index. But like your little wave graph before, the way that it's done that is very different to the index. So that when the market's booming, it's not going as well. But when the market's dropping, it's substantially protecting the downside. Now, if a sleep at night factor, if you've got your assets in retirement phase, and if we're talking about some big dollars here, you might be happy to pay an extra 0.25% for that sleep at night factor to know if I wake up and see the news and says the share markets are down 10%, mine's probably only down 3 or 4 or 5, that's actually okay. That might be fees well spent for someone. For someone else, it might be, no, I don't care, let it ride. But for many people, paying that money, why are we paying that for, is part of what you're getting at. It's not just that the number over the last 5 or 10 years tells the whole story either.
I would also say when you are doing comparisons of returns, particularly for growth assets, please do not look at the 12-month or even 3-year. We want to see, because we're investing money into this portfolio, not for the next 12 months or what the last 12 months did. We're investing this for the next 5 to 7 years. It's a balanced or growth portfolio. So we really want to just compare, because within that, the portfolio managers may have some strategic asset allocation plays and tactical stuff and all that stuff, where, our portfolio looks like a dog over the last 12 months, but we're not investing over the next 12 months or the last 12 months.
We were positioning for the next downturn, and they just made the decision 2 months earlier, and it's going to pay off when that happens, kind of thing. So.
Yeah, no worries. Oh, actually, because I just said to Vince, I can't find it. Do you have a benchmark for the Denali 80 versus VDHG handy? He said, I posted it in the morning, in this group in the morning. I'll tag you when I find out he's out and about. So all that to say, if you go to the advisor and you're just asking for some benchmarking out of curiosity, if they don't want to provide it or give you BS, maybe there's a bigger question there.
100%. Yeah, no, and that's fair. If someone asked me, I'd be more than happy, and the advisor should be sharing it.
Yeah.
Even if the explanation of this is how it all fits together. And it would go to them, hey, can you compare? Most advisors would have software they can compare it against 50 or 100 different super funds.
Yeah.
Hey, my friend's got this fund. Can you add and compare it and show me?
I don't want to get too technical or even defend funds and portfolios that are actually dogs, because they exist. But there could be a reason, for example, and it's all about, they call it the risk-adjusted return.
Yeah.
So it's like, well, okay, our portfolios, they're actually like 0.5% or 1% less than the benchmark. However, there's been less volatility.
Yeah. So beta, like often that's referred to as beta. So how much risk did we take to get that return? So if one fund over 10 years got 10% and they took 100% of the risk, but another fund got 9%, so they've missed out on 1% return. But if they've only taken, to be extreme, 50% of the risk, well, on a risk-adjusted return basis, that's actually a much better fund to be in. They've effectively got an 18% return on a risk-adjusted comparison. Now, this is a generalisation. If I'm in my 20s and 30s and I can't access my super for many decades, the risk-adjusted return might be less important. But if I'm in retirement phase and close to that, I might not want always just the highest alpha being the highest return. I might want it to be factored in for risk-adjusted, particularly if an advisor's done some modelling and shows you, hey, you can achieve all your retirement goals with 7%. Well, why would we take the extra risk to try and get 8 if you don't want to? Yeah. That's then a personal decision. Yeah. But that's why it's not always.
So this is where he was talking about VDHG and whatnot.
Yeah.
Full disclosure, Vince licenses this podcast. Full disclosure, I invest in his product. Full disclosure, if in doubt, assume every time one word leaves my mouth, it's an ad. Just assume the worst anytime I talk. Over 10 years, VDHG, or the managed fund equivalent, has delivered 10.47 over 5 years, 9.93 over 10 years. Over 10 years, their portfolio has delivered 11.57 over 5 years and 11.04 over 10 years. Don't know if you worded that right or I'm reading it wrong. If you induct the fee for Open Invest, because remember we talked about that platform fee, it delivers a net return of 10.92 over 5 years and 10.39 over 10 years. So we know that that's higher than the VDHG.
Yeah, by about 0.5%.
After fees. More importantly, especially for higher rate taxpayers, 7.95% of that 10-year return came as capital growth compared to Vanguard's 3.87. This makes a big difference to the after-tax returns. The Life Sherpa portfolio has delivered lower volatility, which is actually just what I said before. 9.44 compared to 10.4 for Vanguard. Now, that's very technical and geek out, and don't let nuance wreck a good Facebook discussion. How dare you? But there is often more than the rack rate of what's the best return, what's the cheapest fund.
Yeah. Yeah, and if we've had clients come and say, this other thing my friend's in, it looks like it's returned more. I go, yeah, actually it has returned more.
Yeah.
But let's explain why and if that's appropriate for you or not appropriate for you. because, and it's easy to look in the past and go, oh, geez, I would have been comfortable with that 18% versus the 13 I got. Cool, but in 6 months when that one's minus 20% and yours might be minus 10, would you still be as comfortable then as well?
So for me, and we do need to move on, but I don't chase the best return year on year by looking at tables. I look for long-term track record with a portfolio and fund manager. So there might be a next year, if you compare the 10-year return of the VDHG versus the 10-year return of the portfolio that I'm in within my self-managed super fund, if VDHD did better that 1 year, I'm not moving because I'm happy with how the portfolio set up, the transparency. The tax one was an interesting one. Sure, it could be interesting as well for superannuation, particularly the breakdown of income and growth. But with after-tax money, it's more important because the growth, you're not getting taxed on the portion that's income each year. It's the growth, so it's actually better for tax.
Yeah, you're not paying, it's tax deferred, or it's at a capital gains rate, which is going to be discounted versus personal. We said we move on, but I'll focus as well. I think the other important, and I can call this out for you versus yourself, is that someone go, well, Glen's very smart. Why isn't he looking after his money himself? In the fact that you're also self-aware of, yes, you could be doing that, but part of having it involved with someone else that you know and trust is that your personal bias is also then removed versus going, I know that one's underperformed, but I really like it, so I hold on to it. It's important to go, hey, I'm smart enough to know that I can out and should outsource some of these important parts of life.
Yeah, 100%.